me start. First of all, thank you everyone for joining in this session of Iron Thought Leadership. Today's session on SPAC, which is Special Purpose Acquisition Company, promises to be an interesting one. We have been hosting a series of these sessions on interesting subjects month on month with thought leaders from industry, from the investing world, ministers from India and overseas. So I would just say, stay tuned into IEN. We keep having these almost every 4 weeks. Today, I'm delighted to welcome Mr. Saurabh Srivastava, co-founder of IEN, Indian Angel Network, as all of you know, co-founder and past chair of NASSCOM, and co-founder of TIE and IBCA. As you see, he spanned the entire entrepreneurship ecosystem. His Padma Shri, in fact, for entrepreneurship, recognizes his work in helping build India's startup ecosystem. Before I hand it over to Mr. Srivastava, just a small point. We will open up for questions, so do please send them in on the Zoom chat. We'll pick them up and have those responded. Now, over to Mr. Srivastava.
Okay, thank you, Padmaja. And thank you all for joining in today. So as we all know, SPACs right now are in the news all the time. And special purpose acquisition companies, as they're called, from Jan to October, the data I have says about 165 SPACs raised about little over $80 billion. Now, my numbers may be behind, and I'm sure our speakers are going to connect it. So we thought that in all your minds, there'll be a few questions. And some of them might well be, what is a SPAC? How does it work? What is the difference between a SPAC and what we in India know or have known as reverse mergers into a shell company? How is it different from an IPO? When should a company look at SPACs as an option, to list? On the other hand, for people who invest in that vehicle, the investors in SPACs, who should invest in them? What returns can you expect? Why should people invest in SPACs? What are the risks? So there's a whole bunch of questions, and I'm sure you have many more. So to answer it, we actually are very fortunate to have two fantastic people who know virtually everything about this instrument. So let me first introduce Hank Oberoi, who's an IN member, and he's dialed in from New York. Now, he's a global investor with over 30 years of experience across several complex technology and regulatory-centric businesses, and in multiple countries. And he serves on several boards in the US, in Europe, and in India. This includes NASSCOM as NASDAQ as well. Before that, he was the CEO of Earthport PLC. This was a global cross-border payments platform spread across 100 countries. And this was acquired by Visa. And before that, he was a partner and co-COO of the technology division at Goldman Sachs based in New York and London. Now, he is an actual practitioner. He has done SPACs. Then we have Piyush Gupta, and he's a managing director at Sequoia in India for strategic development. And his expertise spans the entire capital structure, including public and private equity, converts, bonds, loans, M&A, you name it. And before that, he was a managing director at Deutsche Bank, and there was head of technology, media and telecom investment banking for India and Southeast Asia. And the way we will do it is, I'm going to request Piyush. He has some slides, and it may be that most of your questions get answered in the slides themselves. So he'll run through a set of slides, and I will then request Hank to come in from his perspective as an actual practitioner of it, and then we'll open it to question and answer session. So with that, Piyush, let me hand it over to you.
Thank you, Saurabh, sir. On behalf of all of us, it is our privilege to be speaking to the IN members. And I think just to be clear, I'm also a practitioner, is just a practitioner from the company side, whereas Hank is on the issuer side. So hopefully my work is not all theory. So let me quickly share the screen. We'll jump into it.
Well, I'm glad you corrected that introduction. Yes.
So I think the idea is to just walk through a few slides of data to firstly just put SPACs in context as why is it even important? Okay, so this slide shows the SPAC issuance, and it is so far predominantly a US capital markets product, though many exchanges in Europe and Asia, such as Hong Kong and Singapore, are talking about it and want to encourage it because they see what's happening in the US, but it is predominantly a US product. So the data here pertains to US capital markets. So if you look here from 15 through 19, so 5 years of data, and the SPAC issuances were a very small amount, right? So in the context of US capital markets, which raises roughly $350 billion or so of new capital between IPOs and follow-on offerings, these numbers are small, and therefore.
I interrupt you to just do a full slide show.
Yes. Thank you for that. Yes. But in 2020, that number jumped almost 6 times to $80 billion and has continued at an even faster pace in 2021, where just in the first 3 months of the year, we are at close to $99 billion or nearly $100 billion. These are staggering numbers. Now, these are fueled by a few factors. One is that there are many startups around the world that have stayed private and therefore are very fertile hunting ground for SPACs to merge with. Number 2 is that interest rates have gone to zero or in negative in many markets in Europe. And therefore, for many investors, the optionality that comes, or I would say the opportunity cost of putting the capital somewhere else has gone to zero. And therefore, they're happy to leave this in because SPACs ask for roughly 18 to 24 months to find a target to merge with, right? So, and again, liquidity is everywhere, and therefore SPACs have become a very good target for investors to put their money in and then trust the sponsors of the SPAC to find good targets to merge with, and therefore give them very good returns on their $10 per share or $10 per unit that they bought it. But I'll come to that. The second thing is what I call the second half of the SPAC trade, which is the de-SPAC. So what happens is that SPAC is just a trust. Okay? Whatever money is raised by a SPAC goes into a trust account and is going to be the same as the IPO. But this number shows you the SPACs that have found targets and have raised capital against it. Now, this is both SPAC as well as PIPE proceeds, and PIPE is nothing but a investment by investors into a public company, right? Simultaneous with the SPAC closing. And that number you can see has jumped to almost $50 billion last year and has already done $50 billion. Yes, sir.
So I think there's some participants suggesting if you could speak a bit louder.
Okay, tell me if this is better.
Yeah, this is better. Yeah, a bit louder because some of this are putting it on the chat group.
Okay. So the number has gone to $50 billion in terms of de-SPACs. What is a de-SPAC? De-SPAC is where a SPAC finds a target and then merges with it and then causing the operating business to list on the stock exchange, right? So it's like a listing, and that number has spiked as well. Just to put this in context of the IPO capital raised. So the blue bars here are the SPAC issuance for the last 7 years. And the gray numbers is the traditional IPO issues. And I think what you'll see is that for the last 5 years until 2019, it was basically the traditional IPOs were significantly larger than SPAC issuance. But in 2020, SPAC issuances were 20% higher than traditional IPOs. That's when everybody sat up and took notice of the SPAC phenomena. And it is continuing in the current context, where in 2021, the de-SPACs or SPAC issuances are 2x, 100% higher than the traditional IPOs, right? So this is an asset class which is here to stay. And therefore, that's why it is getting a lot of attention from all of us, whether it's in the venture capital community, whether it's the sponsor community, which is raising the SPACs, or the companies themselves, the startups, which have the chance to go public via these SPACs. Now, I want to talk a little bit about, I think, an important aspect of the SPAC product, which is in the first part of the SPAC, a SPAC sponsor, let's say Hank, or it could be an institutional sponsor like a P fund or a hedge fund or somebody else who says, I'm a credible investor. I have expertise in a certain area. Okay, let's say it's financial technology, fintech, or it could be, yes, sir.
Yeah, sorry. So I'm getting some Q&A, which they're saying that, can you just describe what is a SPAC? They're saying, look, we have no idea. So I know you're going into explaining just how it works. You might want to put a sentence or so that.
Yeah, so I think the first part is a good place to understand what a SPAC is. So what is a SPAC? SPAC is nothing but what I call a special purpose acquisition company. What it is in plain English, that it is simply a vehicle where a sponsor of a SPAC goes to public market investors and says, please give me money. I will go find an attractive target operating company to merge with, and give me a time period of 2 years to make it happen. Okay. And the SPAC issues units to the investors against that promise of finding a target. Investors say, okay, here's my money. That money goes into a trust. So you see this light green box which says cash in trust. So and I have an example on the next page, but let's say I'm able to convince enough institutional investors to raise $200 million. That SPAC puts all of that money in trust. If the SPAC sponsors are unable to find a target to merge with, that cash goes back to the investors. The difference here is that you've raised the money up front, so there is credibility. When a SPAC goes to a company, says, hey, I want to merge with you, the cash is already there, right? Otherwise, as you know, there are a lot of hustlers in the financial world where people will try to find a deal first and then raise the capital, which may or may not happen. And therefore there is an uncertainty. Now, I mean, I'll give you one example to make it clear that Altimeter, which is a crossover public market and some late stage private company investor, raised a SPAC. They went to Grab Holdings, one of the large tech companies here in Southeast Asia. And they said, hey, we are willing to invest our $500 million, which is a SPAC size, into you at a certain valuation, and you allow us to merge with you, right? Now, the terms were attractive to Grab, and Grab has today announced that they will merge with that SPAC at $35 billion valuation. So that's the essence of a SPAC. The cash is held in a trust, and the trust money will go back to the investors if they don't like the acquisition target, or if the SPAC cannot find an acquisition target. Saurabh sir, did I?
Yeah, no, I think that's good. That will give people an idea, because now when you talk about this slide, they'll be able to relate to it.
Yeah, so that's the first part, which is for the SPAC to raise capital from the public. Okay. Now the second part comes from the de-SPAC. Now, it is not that the SPAC is buying an operating company. Okay, so the way it works, actually, let me tell you, go to the next page. So I think the numbers will make it clear. So if in this example, I've assumed that the SPAC has raised $200 million and all of that cash is sitting in trust. Just ignore everything else around promote and SPAC costs. Now, what happens is, let's say the SPAC finds a company which is negotiated to be worth $2 billion pre-money. Okay, so the SPAC puts in its $200 million into the target company and has an 8% shareholding. There is a product called the PIPE, which is the SPAC has agreed the valuation with the company. Let's say that's $2 billion pre-money. But to validate that, they go to other public market investors, the usual cast of characters like BlackRock, Fidelity, T. Rowe Price, Temasek, and so on. And they'll say, sir, would you like to participate at the same terms as us? We are investing our money. If they say yes, then that validates that the SPAC and the company have arrived at a valuation the market is willing to accept, right? So it's a bit of a validation check. So that creates your second shareholding bucket of your PIPE investors in the target company. Now remember that the existing shareholders of the target operating company, which owned 100%, so now their shareholding is left down to 80%, and that's because you've taken dilution from new capital being raised. The one SPAC nuance here is that the SPAC sponsor, let's say Altimeter, has typically 25% of the SPAC value as their promote. Okay, just think of it as an incentive payment where they're issued shares against this equity, but it's a phantom equity. They're not contributing cash for it. Think of it like the PE model of 2 and 20. So here, this 20% is their share of finding the target and their share of the value. So they have 2% of the capital of the company, because of the efforts in finding the right target, and they get rewarded. And this is like a dilution on the company. Now, the key thing to notice here is that the smaller the SPAC size and the larger the PIPE relative to the SPAC, the lower the dilution, right? So if there was no PIPE, this dilution of $50 million would be quite material. But because the PIPE has no promote, the promote is only on the SPAC, original SPAC, that dilution comes down. I'll just quickly finish next couple of pages, and then we can take more Q&A. Okay, so if you think about the institutional sponsors, what's really happening is that in all the last 5 years that I showed you from 15 through 19, most of the SPAC sponsors were individual people. Okay, so what does that mean is, let's say I have run a media asset in North America and I've been CEO for 15 years or 20 years. I will go to the market and say, look, I want to find targets to acquire and list in the media space. I have credibility. I have run that space. I know that space like nobody else. There's a differentiation, and therefore investors will trust me to find that. Now that is still happening, but the change and evolution in the market is that you have institutions who have long-term reputations to protect are stepping in and saying, I'm a technology investor, I am a healthcare investor, I am a turnaround specialist. I will find companies in my space to list, and please give me the capital. Okay, and with institutions, you have certain other characteristics which come through, which are beneficial from a startup or operating company perspective that may consider the SPACs. On the right-hand side of this page is the PIPE investor. So once the SPAC sponsor goes and negotiates deal terms with a target operating company, how do we know that those terms are legit? And why are they not overpriced or whatever? So the market check on that is now this innovation called the PIPE, where after the SPAC and the operating company have agreed terms, they present confidentially to these public market investors who are well regarded, who look at the deal just like they would in an IPO, and they say whether they're happy with the terms. If not, there's some terms can be tweaked, valuation reduced, or the promote reduced, or whatever it is, multiple mechanisms to say, okay, look, these terms work, and they sign a PIPE agreement, which is a contractual right for them to invest, contractual requirement for them to invest in the company once it goes public. Let me talk about this page, right? So I think many of you would be saying, why? Like, yes, 19 to 20 was a big jump. We saw it, but why was it? So a few things have happened which have made it better for companies than before. So I talked about this already, the first point, which is the evolution from individual sponsor SPACs to more institutional sponsorship. There used to be something called warrant coverage. I don't want to complicate stuff, but the way a SPAC unit issuance works, for $10, you get one share, but also half a warrant, which is accessible at $11.50 per share. So it's an out of the money warrant. If the company does well, it's a great to have that optionality. And many hedge funds who are participants in SPACs, love that optionality, right? In the latest SPAC evolution, that warrant coverage for each unit for each share is dropped to 1/3, 1/4, 1/5, 1/6, 1/7, and now even 0 warrants. Okay, that's great because the company which is being merged into a SPAC doesn't have to worry about this overhang from warrants. The third innovation is around the additional capital. which was not available earlier as an option. But now pipes have become that additional capital, which serves as to make the size larger, but also as a market reference check. So they have a dual purpose here. The fourth point is very important, is research coverage. So in the US, what happens is that research analysts are extremely expensive, and most banks will not provide research coverage on a company which they have not made fees from, unless the company is like, gazillions or billions of dollars, right? So this used to be a real problem for companies. In the latest innovation of SPACs are now allowed to hire advisors who are allowed to write research. So earlier, this used to be seen as an M&A product, and therefore banks would say, hey, I'm providing you M&A advice, I'm conflicted, I cannot provide research advice for public market. It is now seen as a combination of M&A plus a capital markets product, and bank compliance teams are okay to provide research if the banks are financial advisors. This is fantastic for companies. Another important point is financial forecasts. Okay, so earlier when a company went public via SPAC, it is what it is. It's historical information. It is not very informative. There's no research, so it's really awkward to be a public company without forecasts and without research coverage. But now even financial forecasts are allowed to be permitted in SEC documents, and therefore investors can see for themselves what the company hopes to do. This is the reason why many electronic electronic vehicle technology companies have gone public even without any revenues today, because they have LOIs or contracts with multiple OEMs that allow them to put forecasts in, and investors can take their own view over whether the forecasts are realistic or not. What's not changed is that acquisition period. So SPACs still get about 24 months to find a target to merge with, or they return the money. And the final thing is a sponsor promote. It was 25% of SPAC size earlier. It still is 25% of SPAC size. Now, in my view, this is a big area of improvement and is the next variable which will come under pressure from high quality SPAC sponsors. Now, why is that? Because in the P world or the VC world or whatever, right, when you're getting 20% of incentive, you normally realize that after 5, 6, 7 years of work on a company in a PE world, and maybe 10, 12 years of work with a startup in the venture world. In the SPAC world, that incentive is being rewarded to a SPAC sponsor for on average 6 months to 12 months of work, right? So it seems unfair that just because you found a target, you're getting as much as what somebody else, other investor would make in 7 years or 10 or 12 years, right? And therefore, I believe that this area will also come down. Now, there are tweaks to this. Many sponsors in deals to get the right company will say, hey, I will reduce my sponsor promote, or I will give you some, I'll share some of it with the management team or other shareholders. But again, I think this absolute number is still very high and will come down over time. I'm confident of it. Okay, I'm going to take a breather here and see if there are any questions, but or I can just keep going and take them at the end. I want to, Saurabh sir, Hank, any comments so far?
Probably we'll take the questions at the end, because some of the questions are, you may just cover them in your slides.
We have a bunch of questions here that have come up, Piyush, but maybe if you carry on, we can, how many slides do you have?
2 more, just 2 more.
Why don't you run through the slides, and then we'll go into Q&A, and maybe some of those you may want to bring back some of those slides to explain to people.
Fair enough.
Please go ahead.
Okay, so let me just talk about the timeline real quick. Okay, so the SPAC timeline, and I want to highlight one thing that Saurabh sir said at the start, that, hey, is this like a reverse listing into a shell company? I think that's the right way to think about a SPAC is for a company is, am I ready to be a public company? Because the SEC review process and detail and prospectus is absolutely similar to if we were doing a US IPO, right? And so before listing and after listing, we have to be prepared as a company to be a public company. What does that mean? I have tried to capture this in my first box, which is preparation for SPAC and public listing, is IFRS financials for Indian companies or international companies, getting a public company ready CFO, testing your financial processes, getting an industry report, preparing your data room, which is at least 2-3 months of work, if not longer. Then there are, then because there are many SPACs, what the company would do is they would start with the SPAC conversations with multiple SPACs. They'll try to find one they like, which has good terms, and they'll sign an LOI, which typically comes with exclusivity for 4 to 6 weeks. The SPAC will then do its diligence. It's lighter than a PE firm, but it's reasonably detailed, and they'll help the company prepare a pipe deck for marketing. And also, this is the time when the prospectus preparation work starts. At the end of this, you move on to the investor marketing, which is the pipe placement, and then you've got your pipe agreed, and then there's also a business combination agreement, which is nothing but an M&A agreement between the SPAC and the operating company. After which, the SEC draft prospectus is filed. This is very similar to the DRHP process with SEBI, and takes about 2 months to clear. After which, once SEC has cleared all, has asked the queries and questions, and you've cleared it as a company, then you move on to the SPAC shareholder vote and closing a listing. So all in, this takes about 6 to 7 months, and sometimes the preparation time is longer, as we have seen, and therefore that could be 7 to 8 months. Now, how does this compare to a traditional IPO? So what you'll see here is the first box is actually the same as the top box, and it also takes 6 to 7 months or 6 to 8 months. So actually, the absolute amount of time is not different. But then why do companies like it is for one reason. One important reason is that in a traditional IPO process, the valuation is determined at the end of the process. So the companies have been slogging away for 6, 7 months. And then when they hit the roadshow and meet investors, that's when they get the first real feedback on what the appropriate price that investors are willing to pay for that company. Now, remember, this is a very expensive process, a US IPO, okay, running in millions of dollars in fees. And, and that's why you see in US IPOs that price ranges get revised up and down quite severely during those 10 days of investor marketing. Now, in contrast, the SPAC process, the valuation decision is made upfront by the SPAC. So you see that star, which says valuation with SPAC, and then you do a market validation with the pipe agreement. And after that, it is just process. So the SEC process becomes like a, just a, regular thing where at least our whole life around valuation is not dependent on that. And because the SPAC and the pipe are contractually agreements they cannot back out of, it also means that for a company where money and the price is both guaranteed, whereas in the IPO, neither the price nor the size of the IPO is guaranteed until you close your roadshow and you close your books, right? So, and that's why you can, now if you add this together with the fact that a company can provide financial forecasts in the SPAC document, they cannot provide in the IPO document, it starts becoming very attractive. So what you've seen is the companies like Airbnb and DoorDash, so iconic companies, Snowflake, have gone public by the traditional IPOs, but companies which want to pull forward their IPOs by a year or two, have used the SPAC route because they can show the forecast and try to get credit for the valuations or for the financials that they'll deliver in 2, 3, 4, 5 years out. So this is just the kind of key takeaways slide around when is a SPAC more advantageous from a company point of view, which is firstly, if your SPAC sponsor is reputed, has some market understanding and therefore brings credibility to coming in the company. So for example, there's a fintech sponsor, there's a founder who built a company called PaySafe into a $9 billion company. He has raised a SPAC. And then when he talks about to say, hey, I like to invest in fintech companies, the public investors believe that he knows the sector better than public investors would because he's run that business for 2 decades of his life. The second point I spoke about forecasts and therefore better guidance to the market at large. Third point also I spoke about this valuation being negotiated upfront and with and having a market check on it. Fourth point we spoke about, which is basically an acceleration in the life cycle of a company to go public, which is why so many people are considering it. And then, the SPAC does have higher friction in terms of sponsor promote, but that can be easily earned back by either getting a higher valuation from the SPAC because you can give forecasts and so on. And also, having earlier access to public markets is a very valuable tool. And therefore, companies are okay to pay the promote and get on with it. So I'll stop there and take questions, and I can go back to any slides if required.
Yeah. So maybe what I should do, I think, before we get into those questions completely, is maybe I should ask you, Hank, to kind of come in with your perspectives on this. And I'll just mention the flavor of questions that people are talking about. Okay. And I mean, for example, just let me run through. Firstly, a lot of people have said, can you actually run through a live example? And if you can talk about what happened with Renew Power, that would be great, because everybody knows about this. And then there's a question of saying, who takes a hit if there's no DSPAC? And what's the role of sponsors post the SPAC? Who runs the company? And what happens? I mean, do SPAC investors also take a haircut like public market investors do? You know, like in WeWork, Lyft, stuff like that. And what about SPAC formation in India? What do regulations do? And there'll be a bunch of others. I think, will it then go public on an exchange like NVSC or NASDAQ? And how does one make money on it? Is there a conflict of interest between institutional investors, pipe investors, etc., if they start doing all these things? So there is kind of a flavor of questions, but we can come back to the specific question. You know, like, does a SPAC sponsor, is it that a replacement of an investment banker?
Sure. So, you know, actually, that's a great lead in, Saurabh. What I can do is maybe go into one more level of detail on the formation of the sponsor vehicle and the economics for the sponsor, because that'll answer actually a lot of the questions that you just asked. So, you know, before you get to the point of the company that is considering whether to go with an IPO or merge with a SPAC, there's the whole concept of creating the SPAC vehicle, which precedes all of that. And as Piyush mentioned, this is typically either an institution or an individual or a combination of those facts that basically come together and say, we're going to do a SPAC.
So Hank, there's some notifications that are showing up on your screen.
Oh.
Maybe you want to see if you can knock them off. Yeah, okay.
Yeah, I don't want to give away all the secrets.
Yeah. Before something turns up that you might not want us to.
Exactly. Has happened before, don't worry. In the formation of the SPAC, the sponsors come together and they say, okay, we're going to do a SPAC. A number of decisions need to be made, which is what is the size of the SPAC? And those decisions are not costless, because a key factor, which I think is important to understand from a sponsor standpoint, that the decision to create a SPAC vehicle means putting up a meaningful amount of at-risk capital. So before you ever go to the investors and say, give me money for the SPAC and all, you have to put about a certain money. So here's an example. For example, if you're looking to raise a SPAC of $300 million, you will be committing roughly around $9 million of capital upfront, which is totally at risk. The large majority of that goes to paying the investment bankers' fees for the IPO of the SPAC itself. And those fees are typically broken into two parts. There's the upfront part, and then there's a deferred part, which only happens at the de-SPAC. But even the upfront part is roughly around 2% of the SPAC size. So you're talking about $6 million. And then you've got all these other expenses, which I won't talk about in detail, but they add up to roughly around $2 million more. And then you've got expenses that go to operating the company. Because as Piyush said, once you've set up this vehicle, then you take it public. And when you take it public, it's like a typical IPO roadshow. other than that you don't have a business. You're basically selling the experience and the knowledge base of the sponsor, whether it's an institution, individuals, or a collection of those. And so you're basically going to all those sponsors, all the potential investors in the IPO of the SPAC, and it's a typical roadshow. And at the end of it, you'll get commitments, and you will do an allocation, and now you are public. So in that at that point in time, all the money that's raised in that IPO goes into a trust, and the SPAC sponsor and the SPAC cannot touch it. So all the expenses of doing the IPO, of then running the company, searching for potential targets, all comes out of the pocket of the sponsors. And that in a $300 million SPAC, as I said, is roughly around, let's say, $9 million. Now, if you go to the next step then, and you've done the IPO.
So Hank, if I could just stop you there. I think
sure.
Piyush's slide had mentioned 25% for sponsor. So
the amount that sponsor gets is a negotiated amount. So it used to be 25%. The current amount, the most common, is 20%, and some of them even go lower than that.
Yeah, no, but in terms of investment, that's not 25%. That is
no. So sorry. So let me clarify. So in this slide, you'll see there are different buckets of stakeholders in it. The 9 million that I talked about is cash capital that the sponsor puts up. They don't put up 20% of the capital. They put up $9 million of, let's say, cash capital, which are the expenses, and that's at risk. Now you go public, right? So if you've gone public and you've done a $300 million IPO, you've issued 30 million shares at $10 a share. Then in addition to that, everybody that buys one of those shares also gets some portion of a warrant. And that can be, a quarter of a warrant, half a warrant. The most common formula now is either 1/4 or 1/5 of a warrant per share with $11.50 strike price. Then you get the 20% that you're talking about, Saurabh, and that Piyush mentioned. That is the founders promote for taking this risk of putting up this $9 million of risk capital, which, for example, if a de-SPAC doesn't happen, then the investors get all their money back, but the sponsors lose that $9 million. That is completely at risk. So in return for setting up the vehicle, taking it public, finding the target, de-SPACing it, they essentially get 20% of the SPAC shareholding as a promote. So in this example, 30 million shares were issued to the public. The SPAC founders get 7.5 million shares, but these 7.5 million shares essentially have no value at this point in time because the investor shares can be bought and sold in the market, whereas the founder shares you cannot touch them till after the de-SPAC because they have zero value till the de-SPAC because the investor shares are backed by the $10 in the trust. So if a SPAC share is trading below $10, then you can essentially view it as it's trading below par value because at any point you want, you can, after the 24 months is over, you can basically ask for your $10 back. Then there's the 9 million that I mentioned, which basically the sponsors put up as risk capital. That is an investment in the company, and that is used to essentially typically buy additional warrants. And they will pay either $1 a warrant, $1.50 a warrant, or $2 a warrant, and they will get the same warrants as the public market investors got, struck at $11.50. And so the SPAC sponsors basically end up with two forms of participation in the upside. One is founder shares, the 20% of the founder shares, and then the warrants, which they essentially quote bought with the risk capital that they put up. Now, what you will find is, so at this point in time, you've got $300 million in escrow, plus a $9 million of risk capital that's been essentially spent. You've got 37.5 million shares issued, and you've got roughly around 10.5 million warrants issued, some of which went to the public and some of which went to the SPAC sponsor. So this is the scenario post the IPO of the SPAC and before any de-SPAC conversations have taken place. So then the next step that comes up is where you essentially, I'm going to skip this slide, but where you essentially do a de-SPAC.
Hank, just go back to the previous slide, if you would, please.
Yeah. This one or the previous one?
No, the previous one. Yeah, where you're doing the warrants. So
yeah,
you said 4 million private, 4.5 million private warrants and 6 million. Right. No, sorry, I got it wrong. Please go ahead.
Yeah. So basically,
and,
you know, now
and
again,
Hank, before you move off the page, I think actually this is a great page. I want to highlight one thing is that the 20% promote versus 25% promote, Saurabh sir, we are saying the same thing. Why is that? Because this 20% is being calculated on a fully diluted basis, whereas the 25% I was using is on the 30 million shares. You see that 300 million? So 25% of that is 75 million or 7.5 million shares. So it's just the base is different. It's the exact same formula.
Got it. That's a good clarification.
Thanks.
Piyush. Thank you.
Thanks, Piyush. Thanks for clarifying that.
Yeah. So I think this is the scenario now. Just before, you know, for example, the SPAC that I'm running, we are in this stage right now. We basically went out, we created the SPAC vehicle, we did IPO'd it, it's listed now, you know, on NASDAQ, and you can essentially buy and sell that stock out there. And we have the money basically sitting in a bank account in trust, and we are out there looking at targets. So this is the current situation. Now, what happens next is you essentially go out and you look for targets. When you find a target, there's a negotiation that takes place with the target as to the terms and conditions of the merger. How much do they want? There are many factors that go into it. One is, what is the enterprise value that they're willing to sell at? Two is, how much cash do they need? Because, you know, if you use the example that Piyush mentioned, something like a Grab, which even though the size of the SPAC was 500 million, they wanted 5 billion in cash. So the SPAC sponsor and the company together had to go off and find other investors to be part of that merger for de-SPACing process to provide the extra cash. If the seller or the company that is merging with the SPAC needs less cash, then they might want more shares. It's just a way for them to go public without selling too many shares. And so that decision takes place. In this example, what we basically shown is that they were that basically the SPAC was $300 million. The company enterprise value is roughly around $1.25 billion that they want to for it, and they want roughly around $600 million in cash left in the company so that they can use it to grow. So in this structure, you have $300 million in cash in the trust. You go out and raise a $300 million PIPE. The difference between the PIPE investors and the SPAC investors is that the SPAC investors, when they put in the money, they got $10 shares, plus they got 1/5 of a warrant. The PIPE investors, because they're coming in at the point of the de-SPAC, don't get any warrant. They just get the $10 shares. So there's like subscribing in an IPO. And then basically 125 million shares get issued to the owners of the existing company, giving them that $1.25 billion valuation. And so you end up with a total enterprise value of 1.8 billion, of which 1.25 billion is owned by the company that is basically the merging with the SPAC. 300 million equivalent is held by the people who had invested in the SPAC IPO, and 300 million came from the PIPE proceeds. Now, if you look at the share ownership, it's slightly different. The IPO investors get 30 million shares. for at $10 a share. The PIPE investors have 30 million shares. The target gets 125 million shares, but the SPAC sponsor has 7.5 million shares. This was the promote. And so you have basically, the eventual cap table is what is described, shown in the pie chart there, with the target owning 65%, the IPO investor 16%, the PIPE investor 16%, and the SPAC sponsors 4%. So this is kind of at the point of the de-SPACing process. Now, the next stage is what happens post the merger. There was a couple of questions I saw come through the chat as to what happens, who runs the company, who owns what, who makes what decisions, who can buy and sell. So the reality is that the SPAC is a vehicle to essentially allow a company, as Piyush had said earlier, that's ready to go public using a different mechanism with guaranteed amount of cash, a guaranteed valuation that is not subject to the vagaries of the market. But the goal typically is that the management of the company that is merging with the SPAC would be the continuing entity, i.e., a SPAC sponsor typically is not looking to buy a company and then run it. They're looking to find a company, take them public, and then allow them to essentially run the company in a public format. And the SPAC sponsor becomes a shareholder. Now, depending on the nature of the sponsor, a good SPAC sponsor will have a lot of domain expertise in the space that they are raising the SPACs on. So they will continue on and be helpful to the management and the team. And managements and team very often will choose a SPAC sponsor if they have a choice that they think can be helpful to them on a going forward basis. So at that point in time, you go forward as to what happens. Now the stocks are trading in the public market. The company changes its name to the target company's company. The new management takes over, and everybody kind of owns the shares that they own. The investors of the company that merged own a certain number of shares. We said 66%. The public investors, the PIPE investors, and the SPAC sponsors that are out there. So this is where it's a very interesting dynamic and goes back to what I think, again, Piyush mentioned as to there's probably some room for fine-tuning the SPAC economics, because while the SPAC sponsors do take a significant amount of risk up front, but if things go well, the economics for the SPAC sponsors is very attractive. So if you look at the table here, it shows at different price points. You've got a $10 share, $11, $12, $13, $14, and $15 share on post de-SPACing. If you look at the bottom rows here, the sponsor upside, the initial investment, as I mentioned, was $9 million. So at even a $10 a share, if everything goes stable and the lockups expire and the sponsors are allowed to sell their shares, they will make an 8x return. And as the value of those listed shares goes up, that can go up, obviously linearly. And then at some point, post 1150, the warrants kick in, and they have certain upside. Now there's some nuances around the warrants, but I won't go into that detail. But this gives you a rough understanding of the SPAC economics. Now, what's happening in the marketplace today is because there are more SPACs out there than there are necessarily credible companies that they can merge into, certainly in some specific verticals. There's a negotiation that goes on in the de-SPAC process, one of which is obviously what is the valuation that the company will give. But then the second piece is also, will the sponsor essentially give up some of its upside to reduce the dilution on all the other investors that have essentially put in money? So that conversation is also taking place. So, if you had to kind of summarize this whole thing from a sponsor standpoint, you need not anybody. It used to be that anybody could kind of hang up their shingle, and if they could raise the money, it was great. It's become much, much harder to actually now launch a SPAC. Bankers have become more careful as to who they will take public because their reputation is on the line. Investors are looking for, what is your edge? Why will a company that's credible and successful and has great potential, why will it merge with your SPAC? And so they are looking for credible sponsors. What value can they bring? What sector are they going after? How credible are they, in terms of their background, experience, etc. All of those factors are starting to take place. And then also the economics. Now, one of the questions that I saw pass through was, while the money is sitting in trust, pre the de-SPAC, is there any interest paid? Typically, again, those are all subject to negotiation, but the typical thing is the money goes into trust, 100 cents on the dollar goes into trust. And then if there's any interest earned, sort of post kind of managing the vehicle expenses, that would get paid out. But obviously in the current environment, interest is not particularly relevant. And so nothing gets paid. Occasionally, if the SPAC sponsor has a harder time and needs to convince the investors to participate in the IPO, they will do what's called a 101 in trust, meaning instead of putting 100 cents on the dollar in trust, they will put 101 cents in dollar, i.e. 1% extra from their pocket, which means that if the whole thing fails and the de-SPAC doesn't happen, the investors, instead of getting back 100 cents of what the money they put in, they will get 101 cents. So 1% extra, which would come out of the sponsor's pocket, which creates an extra expense there. And of course, when the vote comes to do a de-SPAC, and this is an interesting nuance, which is not obvious on the surface, is that the investors in the SPAC have to make two elections. One is, do they want to vote in favor of the de-SPAC or not? And almost in 100% of the cases, they vote in favor of the de-SPAC because it costs them nothing. And then the second election they have to make is, do they want their money back or do they want that share in the SPAC, de-SPAC entity? So they can vote in favor of the de-SPAC, but still say, I want my money back. It's called a redemption. And the reason why people would do that is because even if they redeem, they get to keep that 1/5 of the warrant and participate in the upside. So there used to be the case where many hedge funds would basically participate in the SPAC, at de-SPAC, they would take their money back and keep the warrant for free. That's becoming less and less common because the proportion of the warrants has gone from 1 warrant to half warrant to a quarter warrant to a 5th warrant and even lower. And then secondly, basically SPAC sponsors are getting more credible. So they will basically look for investors that they think will stay with them post the de-SPAC. So I'm going to stop there and I guess Saurabh, open it up for questions or any clarifications.
Yep, good. You've actually looked at questions as you speak. So you have been addressing many of them. So what we'll do is, one thing that everybody asked is, can you talk about Renew Power? In some way, they're saying, give me an example of an Indian company that went into this IPO through a SPAC process. Would you be able to shed any light on that?
I can't. I'm not close enough, so I don't. I've read some stuff in the public, but I don't have enough insights to be able to talk about it.
Yeah, I can.
Piyush?
Yes, sir. I can. It's a very interesting case study for Indian companies. So I think it's a very important landmark.
So Hank, you may want to unshare your slides.
It should be in the stop screen share.
So then we can see everybody. Okay.
Your video is switched off, Mr. Srivastava. You want to?
Oh, his video switched off. Okay. So maybe while he's doing it,
Yeah, Hank, at the bottom of your screen, if you just scroll down, of your Zoom
Yeah.
screen?
Yeah, I'll do it in a second. Here we go.
Yeah.
Okay, no, he left entirely. So yes, sir. So okay, now this is it's a very good point. So what happens is that in India, Indian companies are not allowed by law to list in an overseas jurisdiction. So what used to happen is that only companies which are offshore incorporated, okay, used to have this option of listing in the US, whether directly or via a SPAC. What Renew has done, so the Renew transaction, so Renew is an Indian company. It is not incorporated in Mauritius or Cayman or any offshore jurisdiction, and therefore it would not have been able to go public via regular traditional IPO in the US. So what they have done is the US SPAC has acquired a controlling interest in the company. Now, what does that mean? What that means is that all the investors who are offshore are able to move into an offshore vehicle without triggering India tax. Okay, again, I'm not the tax expert here. I'm just laying out from a layman's perspective what's happening. So then what the SPAC has done is the SPAC has not bought 100% of the shares. They have bought majority. So they have majority control of an operating company. For the remaining shares, there's a call and a put option. What that means is that in the future, as the SPAC person gets listed and raises more capital, it can issue a call option on the residual Indian shareholders of Renew and say, look, so let's take an example. Let's say that the SPAC is buying 70% of, I'm just using some illustrative numbers, there's 70% of Renew upfront and 30% is residual shareholding sitting in India. And not all of the 70% is cash for cash, because all the offshore foreign shareholders can just flip over into a foreign entity, into the SPAC entity without triggering any taxes. So that's quite straightforward. Each share of Renew Power is exchanged for one share of the SPAC. Now, for the residual shareholders, there is a call option. So the SPAC can say, okay, look, Mr. 30% shareholders, I've got extra cash. I'm exercising my call option. Please sell me your shares. Here's your cash for your shares. And when that cash is received, it triggers India taxes. But there is a matching of the cash flow receipt from sale of shares to when the tax is supposed to be paid.
I think your voice was a little muffled in that last sentence or whatever. What you're saying is that for 70%, because Indian shareholders can't own shares in a foreign company, is that right? Therefore, they acquired 70% and took a call option on, let's say, a certain number of shares, whatever. Now that doesn't violate SEBI regulations because it's prefixing a price for the future.
And also, sir, is structured as an acquisition. So this is not it is not like Renew saying I want to list in the US by submitting my prospectus to SEC. What they're saying is that the SPAC is saying that SPAC is I'm acquiring an Indian company.
Correct. Got that. and they have a call option on the shares they have not acquired.
That's right. Now there is also a put option, right? Because all the shareholders who are stuck in the India Co don't have any liquid currency because the SPAC has gone public, but the 30% shares in Renew India are not public, right? And therefore, what is the liquidity? So they have a put option. Again, I don't know the details of it, but the put option says, I have a right to sell my shares to the SPAC. The SPAC will therefore have to go find the cash. All options exercise. So over time, this will basically become the SPAC will own 100% of Renew Power and will have access to US public markets as soon as the SPAC demerger or SPAC merger is consummated and Renew is effectively listed in the US.
Right.
So but this is a very...
But the Indian shareholders of Renew would basically be bought out. They would not really own shares in the listed US company. Is that correct?
Correct, sir, but except to the extent of what the country already allows in terms of LRS and overseas investments, as we know, the limited schemes and so on. So foreign ownership of stock is not completely banned. We just have limitations on how much you're allowed to own overseas.
Okay, but here they're not using their VRS, right? So
LRS, yeah.
they're not using that, automatic LRS, sorry. So is there a limit for them to hold stock? I mean, they'll have to pay taxes, of course, if there is a swap or whatever.
Yes.
But they don't have
Yes.
to. They don't have to exercise a put, right? To get liquidity, they can be bought out for stock instead, right?
They can be bought out for stock, which is again taxable.
Yeah, it's taxable, but it's allowed, right?
It's allowed. Yes, it's allowed. Again, I'm not the expert on from a tax perspective, and therefore there may be limitations on how much stock you're allowed to receive. But it should not be an issue because you can give it for stock, and that stock can then be sold.
So in essence, what you're saying is that this does allow an Indian company to list overseas in a sense, but not quite, because there's only a certain amount of stock you can have in the listed entity. You're not listing your shares as such. It's through an acquisition process.
That's right. So technically, this is an M&A. You have basically sold your shares to a US listed company, is the practical effect of it. So it's not that Renew has gone public in the US. Technically, it is that Renew has been acquired by a public company in the US, and in exchange, that company has issued shares or cash to the Indian entity.
Yeah. Got it. That's I think that's a good explanation of Renew Power, and in fact, it's pretty much what I guess everybody was asking. There is a question that came in, and this for both of you, saying that is there any place for ESOPs in this, or if people already hold ESOPs in a company? How does that work?
So basically, I can give you an example of one of my portfolio companies has just gone through a merger with a SPAC, and so there are really multiple components of it. So there are stock options that exist in the company, and those typically will transfer over to the public company. So if you own 100 options at a certain strike price, they'll all convert and they'll carry on, and the vesting schedule and all will typically carry on. In addition to that, this is not always the case, but in some cases, in the merger negotiation with in the de-SPAC process, there's a negotiation which then further incentivizes management. So for example, in this particular case that I'm thinking about, in addition to, let's say 30 million shares that were issued in return for the equity in the company, another 3 million shares were issued to the management, but they only vest when the price of the public company crosses certain thresholds. So, 1 million gets released when the price crosses $12 for at least 20 days, So rather than an incentive on the performance of the company, it is typically based on the share price performance, which is what the SPAC investors care about. So there are two forms of, one is the incentive that comes from the de-SPACing process, and then of course the pre-existing stock options and ESOPs, et cetera, continue on.
Right. There's also a question saying, is there an equivalent of SPAC in the Indian markets?
I'll let somebody else answer that.
No, not yet. There is no regulations. In fact, outside the US, the LSE and a couple of exchanges in Europe have experimented, but there are no SPAC equivalent regulations either in India or in Singapore or in Hong Kong or in other major markets. So it is a US innovation which actually was around for a long time. I have done two DSPACs, 5-6 years ago, but the product was not very sophisticated, and only companies that were not very well regarded chose that path, right? So when you had no other option, like that was your best option. But the world has changed now, and we are seeing some very, very good and strong companies choose the SPAC route because of the advantages we spoke about. And that's a credit to the innovation from the regulator and also the participants who have been kind of quite wise to see where they had to take it to make it workable for startups and their shareholders and for public investors.
And that's an interesting point, because when we were going through our SPAC IPO process, one of my views going into it was, look, there's clearly momentum in the market and it's an interesting time. Who knows how long it will actually last for. Having gone through the roadshow and the IPO process, I basically concluded that this is actually a new element and a new vertical in the capital markets, and it's here to stay. Many of the SPAC investors, institutional investors that we spoke to, basically told us that they have now dedicated funds for the SPAC strategy. And 8 different institutional investors out of the 30 or 40 that we spoke to have dedicated SPAC funds, which are over $1 billion each. So the amount of capital that is now allocated to the strategy is pretty significant and is in multiple tiers. There's a sponsor capital, there's the IPO capital, there's the PIPE capital, and then there's the public market capital, and it's here to stay.
Okay, I get it. So a couple of other questions that are here. Are there any ideal targets that SPACs look for? I mean, demography, sector, country, size, age, whatever. Is there anything like that as a pattern?
So I think there's a couple of things. One is obviously when you set up the SPAC, you typically, not always, you typically articulate a particular sector or a target marketplace based on the expertise of the sponsors. So it could be fintech, it could be EV, it could be media, it could be IT services. You basically pick that space. Then the second thing is within that space, what companies are public ready. And my experience in talking to the investors is that SPACs is not, other than in a few sectors like EVs, most SPAC investors are looking for a sure shot deal. They're not looking for turnaround situations. They're not looking for highly speculative situations. They're looking for companies that are profitable with a clear business model that the public markets can understand, so that when they actually de-SPAC, the stock will trade well, and that they can then find liquidity and pass it on to the other investors. So it's not, again, there are always exceptions, but in general, the SPAC vehicle is not considered ideal for turnaround situations or long-term situations where you have to spend the next 5 years fixing the company and then scaling it up and growing it to size.
Got it. One other question. So if, take the case of Renew. So in such a case, the SPAC has bought the company. So whatever IP or whatever the company has, in effect belongs to the new owners. Is that generally what happens?
So actually, I think this is important to note, is that the SPAC is not buying control. As Hank's example showed, and my example showed, in almost all the cases, the SPAC owners end up with a minority in the target company. Therefore, the negotiations between the SPAC and the target company are not M&A-like. We're not selling the company. You're going public. Like as if you're going public in a typical IPO in the US, you would sell roughly 15, 20, 25% of your company. And that's what a SPAC ownership is in the target company. Therefore, companies, we encourage them to think long-term and say, firstly, let's not optimize only for price. Because if you're playing the long game, and we have seen the game, so it's not like I'm selling nuance to Microsoft for $19 billion, where every dollar more to me is $1 more from Microsoft, right? So this is not a sale of the company. This is truly about selling a minority stake in a company, and therefore you optimize for other factors, sponsor quality,
so it's not really transferring IP or anything. It's just getting investment in the company.
The same CEO runs the company.
Yeah.
The shareholders just have reduced ownership. So it's truly like an IPO in that respect.
Yeah, got it. One interesting question saying if you do a SPAC, can you use it to buy two companies or it's one company that you will buy with it?
Technically, there's nothing preventing it from buying two companies, but the de-SPAC transaction is a single event. So you would have to time it in a manner that both those events take place simultaneously. So it complicates the situation. So typically, it's almost always a single one, and then you can do a follow-on where you can buy, because now you've got a public stock, you can buy another company. Having said that, I know of at least 2 SPACs that did multiple mergers in the de-SPAC. One of them actually did 5 in the cannabis space.
Can be done, but it's tricky.
Yeah, it's complicated. Yeah.
Complicated. The other
complicated merger accounting, SEC review and presenting a business for 5 companies instead of 1 company, it is super complicated. I mean, getting 1 company public is hard enough. Trying to do it for 5 is like 1 kid versus 5 kids.
So you have to be truly ambitious to try that.
Yep.
But like Hank said, can be done. The other question is, are you guys, both of you, are you guys seeing interest from some of the Indian unicorns in using SPAC as a process, as an approach to listing?
I don't know about specifically about unicorns, but we're definitely seeing a lot of interest from Indian companies. The SPAC that we launched is specifically focused on IT services and BPO, right? So that is obviously very relevant from an Indian standpoint. And there are many companies that we are in conversations with that are very interested. They typically tend to be global companies with their business being overseas, US-centric, etc. But obviously, many of them have meaningful presence in India. I think with the Grab IPO that Piyush mentioned, and then some of the others that are starting to take place in Europe, there's a much greater element of companies. So in the early stages, most of the SPACs, the investors in SPACs were looking for US-focused businesses. Now I'm starting to see SPACs that are European-centered. Their stated target geographic area is for looking for companies in a certain sector in Europe. I've just seen a SPAC that I'm advising, which is focused on Latin America. And I think you're going to start to see, I'm sure they already are, SPACs that are starting to focus explicitly when they raise their capital on Asia/India.
So there is a question which says, have you, in your experience, seen certain sectors or certain types of companies get better valuations via a SPAC vis-a-vis a traditional IPO, or there's no such study that's been done?
There is, I think Piyush mentioned this a little bit. It is for a company that is growing very fast and believes that the next year or 2 could be quite significant for them. In an IPO, you're not allowed to give forward projections. So it's up to the analysts that are covering the company to give the projections. In a SPAC, you because it's a private negotiated transaction, you can actually share what you think your performance will be 1 year out, 2 years out, 3 years out. So you can bring forward the potential IPO date by sharing future revenues and getting value for them.
That's a very, very interesting observation, Hank. Extremely insightful. There's also a question which says, why is there so much confidence in the SPAC market? Because there's some study at the Harvard Law School which says that there's oversupply of SPACs, undersupply of companies, and so there may be significant underperformance.
Piyush, you want to take that?
Well, I think, look, SPACs are interesting for investors. Why? Because so what happens is that there are many hot companies or many desirable companies, when they go public, you cannot get allocation. In the US specifically, retail investor part allocation in IPOs is maybe like 1%, 1.5%. And in addition, even blue chip institutional investors cannot get allocation. So if you take a typical US IPO, you'll have only 30 investors who allocated stock. Okay, and there might be 200 lines of demand. So you have 170 investors who didn't get any allocation, and for the 30, they got much less than what they wanted, and retail investors got nothing. So SPACs, because they have a privileged access and institutional access into, let's say, promising startups which are going to come to market. And again, my assumption and underlying hypothesis here is that the SPAC target is a company that is desirable to public markets, which is why it's going into the SPAC in the first place. So investors get to play those themes, by being a part of SPAC with low downside. Because if I, as an investor, don't like the target, I can always say, I elect to redeem my share and get my $10 back. The warrant makes that optionality even more attractive, because now hedge funds and so on, like, they play it so well, because like they'll say, okay, look, I want my $10 back, but I'll keep the warrant. And all they've lost is the opportunity cost of interest for that 12, 18, 24 months that it may be locked in, but that's zero anyway, right? And actually in the US, you can get leverage for the amount you put into a SPAC. Okay, so there are lots of kind of very nuanced market dynamics on why it works so well. So I've tried to give you the view both from retail investors as well as institutional investors.
So Padmaja, I don't know how long we could run this, and are there any questions that I have missed? I think I've picked up in general the broad sense that I saw on the Q&A chart.
I think covered most of the questions, either as questions or Piyush and Hank would have covered it in their slides. I don't think I see any real.
Right.
There's one question, Piyush, it may be for you. Would, considering that we are looking at Indian companies, leveraging SPAC, question is, would there be any round tripping issues?
No, the money is offshore, right? I mean, if you look at the SPAC investors, they are mainly US institutional investors. I mean, even the SPAC does not go to retail investors to raise money. So SPAC also raise money to institutional investors. Retail investors can trade it; they can buy and sell on the exchange. So I don't see how there's round tripping element here.
Right.
And I think Saurabh, sir, just on the earlier point about Indian companies considering SPACs, again, we are privileged to be investors in many, many promising startups, and we are actually hosting a SPAC day in a couple of months, where we're going to put together 20, 25 companies which have high or some interest, I would say, in learning about what this is. I think Indian founders are just beginning to get up to speed of the possibilities of this new animal that's certainly burst the scene. I think just in today's session, there are many founders as well who have many questions and want to know how it works. And Hank, we're also inviting, I think the top 15, 20 SPACs. So we should certainly catch up and find a way for you to be part of that SPAC day we can speak about offline.
Right. So you have examples of SPAC transactions that are not like $1 billion valuation?
Yeah, there are actually quite a few. It really depends on the size of the SPAC. So in the early stages of the SPAC boom, even early into 2020, there were a lot of SPACs that were raising 75, 100 million, 125 million. So they might do a merger with a company at the 500-600 million valuation range. That is changing partly because of the banks. The investment banks, the credible ones, would rather do slightly larger ones rather than do lots of smaller ones. So the base, sort of the low end, which was kind of at the $50 million SPAC, would have been considered a very low end SPAC. Now that number is probably closer to 125 million, being a really low, and the typical SPAC is 150 to 300 million. And because of the dilution economics that Piyush and I both referred to, the 20% plus the warrants, if you merge with a smaller company, if you have a $300 million SPAC, you've got 20% of performance warrants equity on top of it, and you merge with a $800 million company, then the dilution is quite high. Whereas if you merge with a $2.5 billion company, the dilution is much lower.
Okay.
So,
but I guess the way this works, maybe a last question from me anyway, is so an Indian resident like me, I couldn't actually be a sponsor of a SPAC, right? Because I'd have to put in a few $1 million, and that permission may be hard to get.
So I didn't talk about it, but there are very sophisticated versions of SPAC sponsorship that are coming into place now. So the traditional was.
So let me ask you, if you're doing a SPAC and I wanted to be a sponsor with you.
You can. So, yep. There are because people join in the sponsor team either because they contribute capital or they contribute expertise or reputation. So for example, in our SPAC, which is public information, one of the participants is the ex-CEO of Wipro, because we are looking at IT services. So Suresh is the co-CEO there. We have the ex-CEO of Uber Asia. He's participating because he brings a whole different dimension, and he used to be the CEO of Goldman in India. So he brings a reputational dimension. So you can do that. There's also another model. I'm participating in 4 other SPACs right now, not as a sponsor, but as an advisor. So SPACs will bring in people onto their advisory group, give them some sponsor shares and equity upside, and in return get access to their network of potential target companies.
Got it. So it's not through capital contribution.
No, it's not just capital.
Participate in SPACs. Yeah. I thought many of the people may be thinking of that. So I thought, let me actually answer that question. So I guess, Padmaja, if there is nothing left unanswered, then maybe we should wrap it up. It's been actually a fascinating session. And I really want to thank you, Hank, and also Piyush, for devoting the time to this substantially. And probably, Hank, we should do a separate call between you and me and Padmaja,
Okay.
which is to look at some of the investments we have, saying, do they make sense for SPAC? Because we have, I think, a few that could be interesting.
Yep. No, absolutely. Absolutely.
Yeah.
Thank you, Saurabh sir, Padmaja, really appreciate it. And to all of the IAM team, fantastic to be here and talk to everybody. And, hopefully we answered some of the questions. I tried to answer as many questions as while Hank was speaking, but I think the questions are going faster than I could respond to that.
No, I think
that just endorses how interesting the session was, right, Piyush, for so many people to be engaged and ask questions. So actually, we really thank both of you, Piyush.
I mean, we had close to like 50 questions, so that's quite rare in our sessions. So, and thank you both, because you really did do some real effort in putting together those slides and those charts, because they really helped bring this whole thing alive. Thank you very much.
Thanks for organizing it.
Good evening, everybody.
We'll catch up offline, Piyush.
Yeah. Thanks. Bye.
Take care.
Bye. Bye.
Bye.